Hello and welcome to the Investing with IBD podcast sponsored by Direction. It's Justin Nielsen here, your host, and it is November 22nd, 2022. We're coming to you a little bit early this week since there is a Thanksgiving holiday. So we're going to get this dropped early so you have something to do while you're traveling over the holidays. And joining me as always is Arusha Paris. He's a portfolio manager at O'Neill Global Advisors. How you doing, Arusha?
I'm doing pretty well, after that helmet
Don't
in
say it.
the background, after you saw
Don't
that
say it.
helmet running past your team over and over again, and
Oh,
you saw it
man.
live too. I mean,
I did
I'm
see
sure
it
that was
live. I
fun.
was there. I was there with my college roommates. It was a lot of fun. Of
It
course,
was like old times watching USC beat UCLA, right? Reminded you
no,
of the college
when I was
days.
at UCLA, I think we had an 8-year run of
I don't
beating
believe it.
USC.
I don't
So I
believe it.
never experienced that
Fake
heartbreak.
news.
Fake news. Okay, well, you go ahead and look in the 90s, but uh, we'll go ahead and check that on our most reliable source of information. So we'll get back to you on that. But yeah. Anyway, it was a fun time. Wish you could have been there, and I was
Yeah.
actually willing to do a bet last minute. Arusha pulled out. I was going to say something like, loser has to wear the other team's jersey, but hey, look at me. I'm wearing blue
Maybe
today
I'm
because
gonna.
no bet was taken.
I'm gonna wait for a couple more years when USC just keeps getting all the best athletes in the country, and
Well,
then happy to take the bet.
when it's like a sure thing. Okay,
Yes.
very good. 60% odds were not enough for you. Well, okay, let's get to the show. Now that the football talk is over, we've got Scott St. Clair. Talk about your athlete. Scott St. Clair, he was a senior product market coach forever, but now since Arusha decided to vacate his post, Scott took over, and he is now the premium products manager. Welcome back to the show, Scott.
Thanks, guys. I was jealous. I love talking football. Would be glad to. I know we've said it every time. Let's have a football podcast.
Well, we
Nobody
could
might
talk about the
listen, but
fantasy
it'll be
football.
fun. Yeah. No,
Arusha's been making some.
I'm no good at that.
Yeah, maybe we'll have to wait and see how the season ends. But hey, on the show, Scott is going to be helping us dissect what's going on with the market and also a learning lesson. Hey, the fact is, leaders don't last forever. So we're going to talk a little bit about that and what some people should take away from the destruction we've seen in some of these former leaders. And then Scott's also going to share a few of the stocks that are on his radar. So let's get right to it. Maybe, do you want to start with the NASDAQ, or is that, old news for you, Scott? Do you want to take a look at another index at this point?
Yeah, let's pull up like VTV, the value
VTV, right. So,
ETF.
yes. So VTV, of
And I
course,
only
is,
say that slightly tongue in cheek, Justin, as I've mentioned that on IBD
oh, not at
Live a
all.
number of times. This is where the money is going, right? And look at the performance of this ETF in the last handful of weeks. Amazing. And I think 8%. Oh gosh, now it's only 5% off of 52-week highs.
Wow.
Hard to believe in the destruction that this bear market has created. So uh, it's the old adage, the leadership in one bull market does not lead the next, almost always. 3 out of 4 roughly are going to go by the wayside. You'll get your Apples and Googles sometimes that are so sound, so strong companies that they will come back on the next cycle. But the Carvanas, the Twilios, the upstarts, they're not coming back for the next cycle. So there's your 3 out of 4,
If ever.
So yeah, it's true. I was being kind with with that statement. So yeah, it's very noticeable strength in this area. And it's hard though, because as growth guys, and I know we're all trained to look for stocks with big earnings and sales and return on equity, and so it's not necessarily our favorite spot. But if you want to participate, you got to trade the market that you have, not the one you want.
Right.
And this has been a really strong area.
Mm-hmm.
Yeah, so you were talking about the leaders of the current cycle aren't going to be the leaders the next cycle, but then you bring up a value ETF, which were probably leaders 50 years ago. So how do you balance that, where now you kind of just have to take off your growth hat, right? in some ways, or how do you manage that? Do you start seeing some of these ETFs, these value ETFs, and say, okay, maybe let's not push the growth angle at this point and focus on this area of the market?
I tried. I haven't handled this very well. I identified the strength here in VTV. I just had a hard time, Marusha, just pulling the trigger. I did buy it. If it was the QQQ, you know, 20 years ago, I'd have been loaded up in it. So it was hard. I don't have quite the position in it that I would normally have. Plus, I'm not really an ETF guy. I prefer to find the leading stocks. I want to own the individual stock.
Right.
So, but I just said, you know, this looks like it's going higher, and I had very little exposure a few weeks ago, so it seemed like an area to, you know, kind of ride the wave.
Mm-hmm. Now, what about something like the Dow Jones Industrial Average? I mean, this is another one that has certainly been looking very different. Now, granted, this is this is only 30 stocks in there, and it's price weighted, so sometimes you can have over-representation by just a few stocks. I mean, not that the other indexes aren't susceptible to that as well, as we've seen. But you know, what's your take on what's happening in the Dow Jones Industrial Average, and is this something that investors should be paying attention to as well?
Yeah, I think there's a story being told here on what's moving the market, and it's kind of caught everybody flat-footed. I'm presuming it especially caught me flat-footed. I can't remember the last time I've bought, you know, like the Diamond, the DIA ETF. It's probably been 10 years since I've bought that, Justin.
Mm-hmm.
And, you know, and here comes the Dow, hold my beer, right? It's just like it's the best index of the big indexes. It's clearly the best one, followed by the S&P, followed by the NASDAQ. And so, yeah, as soon as you start to, you know, kind of forget about something, that's probably right when it's, you know, ready to turn around. I can't be the only person who's given up on the Dow, right? I imagine there's plenty of mutual fund managers and hedge funds and active traders that probably don't really look at the Dow, not like they used to.
Mm-hmm.
Yeah, and so when you see the Dow doing this, when you see the VTV doing this, is this more a kind of a flight to safety? Or is it kind of a rotation more towards industrials and where those are starting to become more of at least the slower growing areas that are the best options in this environment?
My thesis is that this is a sea change in the market. We've had a massive bull market since 2009, you know, sprinkling some corrections along the way. And that bull market was led by tech, consumer discretionary, Amazon, Apple, if you want to consider that consumer discretionary. And I think that game's over. I think now they're not going away, of course. They're fantastic companies, but the stocks are waterlogged. They're overowned. You know, at one time, the Swiss National Bank had more than 5% of its balance sheet in Apple stock.
Wow.
Warren Buffett has a massive position in Apple. I just don't know who's left to own Apple, you know, and I joked on Ali's, you know, the Barron's Live that, you know, the next in line, I guess, would be aliens to come down with plenty of money and buy Apple. Because if you don't already own Apple as a I'm thinking big asset manager, big, you know, sovereign wealth fund, if you don't already own it, or Amazon or Tesla, you know, why now? You know what I mean? It looks like the growth curve has changed for these. And so I think it's a big sea change that the money is coming out of the QQQs. I would not own the QQQ. If you want to own the market, I would own VTV or Diamond or SPY. I would not own the QQQ. I think it's going to be a laggard for a while. This was a massive bull market for a long time. So in essence, I think it'll take a long time for that money to gradually come out. It's what we've witnessed this year, I think, which is why it's been such a lousy year. The money has gone out of the Microsofts, the Apples, the Googles, the Meta, Facebooks of the world. And that money needs to find a home. And maybe it could find a home in bonds. You know, you could get you could get 4%, I think, on a 10-year now, or something close. But if it has to be in equities, where's it gone? So you've had a little bit go into energy, and maybe a percentage of that is going into value as well. Although, I don't know what is a value stock, right? I don't know exactly how you define that, but that's why I like that ETF. I'll let that ETF kind of give me a proxy for where the money is probably going.
Well, let's maybe talk a little bit about this kind of sector rotation that we've seen. But first, let's kind of define some terms here, because you talk about there being a sea change. Is it really a sea change, or is this more of a tide thing, where the tide has come out on certain stocks, but it will roll back in? I mean, we see this happen sometimes, where a bear market will last a certain amount of time, and then maybe it's not the same stocks, but it's a new batch of stocks in growth or in tech or in retail, kind of the new crop of leaders that are doing something different, something innovative. So do you think that this is a sea change in terms of what kind of permanence, I guess? Is this something that lasts a year or two and then it's back to growth, but maybe different growth? Or is this something that, hey, maybe this is something a little bit more prolonged?
I think the latter. I mean, now look, Justin, I'm a trader, and I changed my mind fairly quickly, and so I'm always willing to change my mind. But I like to have a narrative, like a thesis on what's going on, and it's something I've tried to get better at for the last few years, because I really miss like the EV narrative or the solar narrative, and I just didn't have the imagination on how far some of those stocks could go, and I think it's that that's kind of what I'm thinking here. I think it's a big change, like a long-term change. The percentage of the S&P, I think, is last I saw was 25% information technology. Now, do they consider Amazon information technology? Probably. And is that correct? Apple, it's all how they group all these things. But when you consider all those companies being so large a percentage of the S&P, and energy being so little of the S&P, and that it doesn't mean it's timely. It doesn't have to end today or yesterday, because this has been an issue for years. It's not like we just woke up one day and it went to 25%. But if you study history, we're at the extremes, and so based on history, I think that's going to change. I don't think energy is going to become 25% of the S&P. They just don't have the earnings power that some of these companies had. There was a reason that they became so large, Google, Amazon, Apple. There's a reason that they did what they did. They're such great companies, huge earnings power, great margins, et cetera. But for energy to go from 3 to just the median, historically, maybe 10 or 12, that's a triple. Because I think it's already gone from 3 to, say, 5 now. So at one point, though, before this year started, I believe it was around 3. So if it went from 3 to 12, that'd be a quadruple. Now we're staring at now, I think it's around 5 or something. So a triple or 2.5-fold, but that's not going to happen overnight. But I think that the money is gradually, slowly, it's a poker game. They're trying to move their chips into a different pot very slowly without giving away their hand. And I think that's what's going on and what has been going on this year.
Yeah, I wonder if all of that has to do with, or part of it, is, they're trying to bring more of the supply chain back, right? And so that's probably leading towards more infrastructure investments, and maybe more towards energy independence, right? And all these kind of things. Maybe the market's kind of looking out ahead and seeing these things, and that's where kind of the money's shifting. So from that kind of narrative, and kind of looking out for the next 5-10 years, I think that would kind of make sense.
I think so too. Now I love the macro, Urusha. I love to read about it, and it's cool. I watch the YouTube videos of these smart macro investors, and I
Right,
listen to,
right,
I've 50 podcasts,
right.
and but I never trade the macro, and there's a reason that I don't want to say I never do that because I've gotten run over in my 25-year history trying to trade the macro. And if you try to trade the macro and get it wrong, you can really get hurt. That's why I've known of some people that, a friend of mine had a friend that, he was right on the macro about like the Fed printing money and doing all of this and all that, and his trade was gold, and he loaded up in miners.
Yeah.
And he loaded up and they went down, and he bought more, and they went down, he bought more, and it just was just like devastating for him and his family. It was a really sad story, unfortunately. And he was he was sort of right. The Fed did what he thought,
Yep.
but the market didn't react the way that and so to me, it's the price. You get paid on price. The smartest, biggest fund managers in the world, they vote, and they don't call me up and say we like XYZ here, unfortunately, but they leave the footprints like Bill would talk about, right? Elephants in the bathtub. And so if you learn to interpret that price action, whether it's energy or VTV or the lack thereof of that price action in the NASDAQ this year, the NASDAQ has really been a laggard. There's been many days this year where the market was up and the NASDAQ was up less than the market and or even down. You just get these clues. You have to believe what you see sometimes, and build that together.
Yeah, I mean, that's always been my problem with the macro is if you spend too much time on it, you can easily convince yourself that you must be right on a certain thing happening. But the timing, just the timing being off a little bit, because you got to think macro, it's not an exact thing, right? So if you're a year off, 2 years off, then
Yeah.
what happens in the meantime if you've loaded up, if you don't have risk management principles in place. I mean, I always think of Alan Greenspan's speech, irrational exuberance, when that phrase was used. I think it was 96, 97.
It was 96.
Yep.
Late 96. Yeah, I've
So
studied
I mean,
that.
he was right. There was an irrational exuberance,
Yeah.
but it didn't stop the market from going up another ton in the next few years. So the timing, and I guess that's where it comes down to charts, right?
That's a great example. Yeah, if you're younger than us or me, I'm the oldest here, but if you're on this podcast and you're yeah, Justin always reminds me, and you want to study history and about, that's a great example that go on the internet and search Greenspan's irrational exuberance speech, get the date. I think it was December 96. Mark it on a monthly chart of the NASDAQ and tell me how well that worked. In the end, it worked. Yeah. But boy, if you had gone short there, from an irrational exuberance standpoint, you never would have survived it.
Well, yeah, the market said essentially, "Hold my beer."
Hold my beer. You think this is irrational? Hold my beer.
I'll show you irrational.
Who invented "hold my beer"? I love that saying.
Yeah. Well, speaking of irrational exuberance, we're going to talk about when some of the leaders, have such great theses behind them, but how to know when it's time to leave them. So when we come back, we'll talk about a learning lesson from Scott St. Clair. Stay tuned. We'll be right back.
The Direction Hydrogen ETF offers exposure to the top 30 pure-play hydrogen economy companies by largest market capitalization, leading the way towards net zero emissions by providing more accessible, efficient, sustainable solutions across 5 hydrogen-related subthemes. With clean hydrogen-based energy expected to grow 5 times in the next 30 years, companies building hydrogen-related businesses to generate power, heating, transportation, and more will likely thrive.
And welcome back to the Investing with IBD podcast, sponsored by Direction. It's Justin Nielsen here, along with my weekly guest, Arusha Pires, portfolio manager at O'Neill Global Advisors, and our guest this week, Scott St. Clair, frequent panelist on IBD Live and the premium products manager of MarketSmith and a lot of other products for Investors Business Daily. So let's get into this a little bit about what is going on with some of these former leaders. I mean, you mentioned a few. There's a grab bag of stocks that are down 80% at this point. So how is an investor supposed to know when the party is over? When you've got these phenomenal stocks and they keep on coming back. They'll have these corrections, these bases, but they keep on coming back. How is an investor to know when the party is truly over on these leaders?
You can't know, I don't think. That's the problem. And the what you mentioned is so true, is that they come back, right? So you think it should be sold. If you sell it, they come back, make a new high. And they constantly train you that you don't want to sell until you do. So I was telling Arusha, we were talking yesterday, and I was telling him, I think there's been maybe 4 to 6 times in my career, 25 years, where having sell rules, and I'm referring to individual stocks. If you want to buy mutual funds or broadly based diversified ETFs and buy those till the cows come home, that's fine. That's a sound strategy. That's what I do in my 401k. Part of it is just, rain or shine, I just buy and buy. But for individual stocks, I believe you have to have a sell strategy. So 4 to 6 times in my career, it's saved my bacon. 2000, 2007/8. Now, 2021-ish. And all the other times in between, it's hurt me, to be honest with you, because I'll sell an Nvidia, or I'll sell a Tesla, or I'll sell, you name 100 of them, and and that they go higher. And that's kind of what happens, because you're in a bull market, and the bull markets tend to last a lot longer than bear markets. But the math is cruel, as we are learning, to the downside. It doesn't seem fair that you make 100% on the way up is the same as 50% on the way down. So you have to have sell rules, I firmly believe, and it's been ingrained. And I learned about selling from all the years between the O'Neill seminars and reading Bill's book, and just from making mistakes too. And the problem with selling is it's difficult. It's not easy. Scott O'Neill, who's Bill O'Neill's son and portfolio manager forever at William O'Neill and Company, he used to always say that selling is 3 times harder than buying. And then he would say, and maybe it's even more than 3 times. So it is not easy, but you have to develop you should have some kind of plan, whether it's somewhere off the highs that you're going to do some selling, or somewhere on the way up. If you have a really good stock, you're going to do some selling. And I really believe in like taking a bite of the apple, so to speak. You don't have to eat the whole apple, but if you have a really good stock, you have 1,000 shares of XYZ, you sell 100 up 20%, you sell another 100 up 35%, you sell another 100 up 60%. And we're all so greedy, right? All we can think about is those 300 shares that we left behind. I would say concentrate on the 700 that you still have. That would be be the best strategy, and then it won't feel so all or none type decisions, especially in selling. They probably put tremendous pressure on people, is my feeling, and so you get you frozen if I've got to sell all of it. I love Tesla, I love Apple, I love Google. I'll never sell Cisco. That was one that I used to hear as a broker in the late 90s. And those
or
same
even worse,
people
buy on the dip.
Yeah, that's a whole nother podcast, right? I think that's probably worse than no sell strategy. At least if it's a no sell strategy, you're not adding to more, creating more of a problem each time the stock goes lower, which, for some of these people, the favorite names out there, I think there's probably some tickers out there that people were shocked how far down they've gone.
Mm-hmm. Yeah, and Scott, I think that a big part of this is that emotional attachment, right?
Yeah.
People they don't want to be wrong. And once they're right, they don't want to give up on that, right? There's this emotional bond that, I mean, I went through that too. It became really hard to sell some of these stocks early on, but I think once you kind of get the selling down and you get over past that kind of emotional bonding with these stocks and realize that they're just vehicles, it becomes a lot easier. So even if you are wrong, even if you do sell something on the way up or sell something when it's hitting your stop loss and it immediately turns around and goes up without you, you're much more willing to just get back into it again, because you don't have that kind of, you're not beating yourself up. You're not letting your ego get the best of you.
Yeah, in the next segment, I'll talk about a stock that I got stopped out of and bought back the same day within hours, because it hit my stop. All right, I followed my rule. I got out, and then it did something very unusual, very strong. It just like total change of character. And I said, I think I need to buy that back. It turns out the sell was a mistake. Well, I don't want to say that.
Not
The
really,
sell was not a mistake. I did the right thing, but that happened, and I went back in. That's rare. I don't usually do that, but I don't have any problem going back to a name that I've sold if it sets up. But the stocks don't know that you own them. They're going to do what they do without you, whether you own them or not. They're going where they're going, and you can't stop that from happening, whether it's going up or going down. You can talk to your blue in the face. You can tweet all day about XYZ being a value stock because it's down 50%. It is not going to influence the stock. There's just massive factors, forces that are taking that stock where it's going to go, with or without you. So you might as well learn to go with it.
And that whole concept of buying something back, it's something that I think a lot of people miss out on, like that mentality. And I saw Bill do that. I can't tell you how many times with Apple, where he definitively said, yeah, I think this is done. He said, look at the topping signals, look at this, and he had all of these reasons why he thought getting out of Apple was a good idea. He started buying that in 2004 after a cup with handle that it came out of that was really nice looking. But then I remember a number of times where he was like, oh yeah, this is done. But then it formed another pattern and he got back in. Sometimes it was at a lower price than his ultimate sells and exits. Sometimes it was at a higher price. And each time it didn't really matter that he had sold it before, and that whether it was right or wrong, it was right at the time, and now he was adjusting to the new reality. And if something changed in the chart, he adjusted with it, and it was just that simple. If Apple had continued going lower, he would have pointed to it and said, see, I told you it was I told you it was time to sell right there. The fact that it came back, he at least could point to the fact that he wasn't so stubborn to ignore the buy signal, and he said, look, I bought it right here and I participated in this big move, so what's the problem?
Yeah, if you sold ABC and then it changed, but I changed the ticker. You couldn't see what the name of the company was. We just blacked it out in the chart, and I just gave you this chart, and you said, oh, I'd buy that. And then I take the tape off and say, it's ABC. You just sold that 3 days ago, $5 lower. For most people out there, that would influence their decision. They would second guess their decision to buy it, right? Whereas for, I think about it a little bit. It's not ideal, but I think it's going higher. I want to participate. I'm just going to go ahead and buy it back. And in the whole, the whole tax thing and all that, some people have that issue, but I don't really worry about that. And there's plenty of, and me and Justin's been a big proponent of it, but I'll scream from the rooftops, get a non-taxable account, Roth IRA. You know, my kids have Coverdale accounts. I love the non-taxable accounts. They're awesome. They're amazing. But I have a taxable account, and I do the same in the taxable account. And at the end of the year, I should be lucky to have to pay taxes. That means I did well enough to that I made money. I've had years where I didn't have to pay taxes. I like the years where I have to pay better.
Yeah, it's amazing. Like, and you know, really over these last since 2009, how long this super kind of bull market, even though you had a number of kind of corrections within it, yeah, how well some of these stocks did, and 9 out of 10 times you got away without having any sell rules, right?
Yeah.
Where these stocks would just keep coming back. And so maybe we should go. I mean, we looked at Apple here, and Apple's done insanely well, and there were plenty of times where you might have sold out of it and things like that, and you buy it back. But let's maybe go over kind of the poster child of 2020, Tesla, right? Because Tesla, we've all been thinking Tesla for a while. It's like maybe it needs to come in. A lot of these other larger cap stocks were already breaking down. Besides Apple, all the other big ones were breaking down. But Tesla was the other one that was just kind of hanging in there, wasn't breaking, and everyone's kind of wondering, you know, how long can that last? So let's talk a little bit about that, because that, if you want to talk about emotional attachments, it's really Bitcoin and Tesla are the ones that are the things that a lot of investors these days, retail investors, are really emotionally attached to.
I agree. I don't think there's, and it's a little bit of recency bias, but I don't think there's ever been a more controversial, for lack of a better term, stock than Tesla. The extremes, you know, they've got the Tesla Q community where there's people that literally think it's a zero, that it can go to zero. And then you have the other extremes where, you know, they've got rockets and robots and flying cars, and it's, you know, it's worth Apple and Saudi Aramco, is that the right name of the company, combined. And the truth is somewhere in the middle with almost all debates, right? So it's one of the best, funnest stock stories out there. Sometimes it's a difficult stock to trade, and I am short the stock, of full disclosure, and have been for a lot of this year, because it's had so many sell signals that I just couldn't help myself. I just felt like I wasn't doing my account justice if I didn't. You know, I observing all these sell signals. Everything about Tesla was telling me it was a short, and I've tried shorting it before, and I've been long Tesla before as well. I'm indifferent to either side. There's no bull or bear side. There's just a right side. I want to be on the right side. And I think the right side, and it has been so far, is you know, shorting. But from a selling standpoint, if you owned a Tesla, the problem with sell signals, in Bill's book, How to Make Money in Stocks, he's got like 16 sell signals. So it's really hard to pinpoint. You know, there's no like, oh, that tells you it needs to be sold. And my experience is almost every sell signal, the first one is not any good for a big stock. The second one, probably not. The third one is okay. The fourth one. And so you keep getting rewarded for ignoring sell signals, if you're long the stock, because eventually it'll go down for a little bit on a sell signal, but then it comes back.
Well, I mean, we'll just interrupt you there very quickly. I mean, there were plenty of sell signals in 2017, 2018.
Yeah.
And, you know, the stock did go down, probably 40, 50% off the highs at that time. And then once 2020 and really 2019 got going, all those mistakes were forgiven.
Yeah, and that's why people now sit here and say, well, it's going to come back, because it did previously. And I will tell you that maybe.
Yeah, it might actually come back. Yeah. We don't know. Well, right now,
I'm not going to say it can't. Yeah. And I'm not going to put I promise you, if Tesla makes an all-time high, I'm not going to be shorted. I'll be out long before that. So, but history says there's a really good chance it doesn't come back, or it goes sideways for a long, long time in kind of a dead money period, like a Cisco did, or an Intel, or a Microsoft. Although Microsoft, went on to make new highs, it took, Microsoft did nothing for 18 years.
Right.
So these are, and these are the best companies in the world. I know there's Juniper, for example. How many people know about Juniper, JNPR? Well, I remember that was an amazing stock. Fiber optics, going to the moon. It was a meme stock before meme stocks existed. And it has not seen anywhere near those 2000 highs. And, in all honesty, probably never will. And you're staring at 22 years of being down. So I could give you a million examples like this, the widow and orphan stock, AT&T. That was a stock that, you just put, that's how it got the name, Widows and Orphans, because it was the safest stock in the world. You collected the dividend, and it went up or down, 5 or 6% a year, and hasn't seen highs in forever. So history says that very, very few of them, like we were talking about that study that the Arizona State professor did, and in roughly 6% of the stocks that existed have generated all the market returns. 58%, I believe, is the right number. 58% of the stocks underperformed T-bills over their life cycle. So what that tells you for them is be diversified. If you're diversified, you'll catch an Amazon, you'll catch a Google, because you own 300 stocks or 500 stocks. So you're always going to catch one of those. And then the good thing with stocks that go up, they become a greater percentage of your portfolio. And the ones that go down, every time they go down, they make less and less of a dent in your portfolio. Yeah. And that's the good thing about it. But to me, what that study tells me is, if you want to be in individual stocks, and I do, and most of us do, because if you get it right, the upside is tremendous. But you have to have a sell rule, because you have to know that more than half of them over their life cycle are going to underperform T-bills. So have a sell rule, or a couple of sell rules. And it's hard. I'll tell you, it's not easy, and you're going to make some mistakes, but it's worth it when you avoid a Twilio or an Upstart, or Carvana, or there's so many of them that were so great, just last few years, 18 months ago. These are just incredible stocks that seem like they were on their way to big things, and they've fizzled, and probably are not coming back.
Well, and to your point, it's not just these high flyers. Sometimes it's those widow and orphan stocks, right? That so many people got into the habit of, oh, you just own this no matter what. It's been around forever. These are safe. I think 2008, the great financial crisis, kind of dispelled that myth to a lot of people, when we just saw some of these institutions just go belly up, and they're gone, right? And they were considered kind of on the safer side. To the same end, I think it's worth remembering that while indexes, you look at the history of the market and you see how the indexes have performed so great over time, decade after decade. Even the indexes don't buy and hold forever. There's not a single stock in the Dow Jones Industrial Average that was there at the beginning in the 1890s. General Electric, I think, was the last one of the original, and that was dropped, a couple decades ago. So they're constantly, changing their mix up too.
The indexes, no one talks about it very much, but the indexes, what do? They add to their winners and they cut their losers, right? Because most of them are weighted. So as these stocks go up, they become a bigger portion of the index, and the stocks come down, they become less of them, and or they remove them. I know they don't do that often, but secretly, I think they've all read Bill's books. So
that's hilarious. It's really, really funny.
Yeah, they just don't say it out loud, right?
I mean, I think that's an excellent example, Scott. If you want to see the strategy in place, take a look at the S&P or the NASDAQ, right? Because they are pretty consistently adding to the winners and getting rid of their losers, over time.
Yeah, it's a long window of that,
Right.
but that's what's happening. That's how Apple becomes, whatever, 8% of the S&P or whatever the number is.
Right. Okay, when we come back, we're going to talk a little bit more about some individual stocks that are on Scott's radar. Stay tuned. We'll be right back.
The Direction Hydrogen ETF offers exposure to the top 30 pure-play hydrogen economy companies by largest market capitalization, leading the way towards net zero emissions by providing more accessible, efficient, sustainable solutions across 5 hydrogen-related subthemes. With clean hydrogen-based energy expected to grow 5 times in the next 30 years, companies building hydrogen-related businesses to generate power, heating, transportation, and more will likely thrive.
Welcome back to the Investing with IBD podcast, sponsored by Direction. It's Justin Nielsen here, along with Arusha Piras, O'Neill Global Advisors Portfolio Manager, and Scott St. Clair, frequent IBD Live panelist and the Premium Products Manager for Investors Business Daily and MarketSmith. So let's get into some stocks, Scott, that are on your radar. Where do you want to start? I mean, energy, you kind of started with that at the beginning of the show when we were talking about the markets. Do you got some energy names for us that are still on your radar?
Yeah, I'm mostly of my long ideas are energy related. So Schlumberger would be the first one that we can go over. I definitely own that one. SLB is the ticker.
Mm-hmm.
And that's
they recently
the one...
changed their name to SLB to make it easier for
everyone. Did they?
Yeah.
Versus...
So you don't have to worry about how to pronounce it. Do you do the French? Do you do the German? What is it?
Schlumberger? Is it Schlumberger?
Right.
It's Schlumberger.
So their name is SLB?
Yeah, so now it's SLB.
All right. Well, good for them. I'm glad they did that for us.
So maybe that's why the Scott starts going up.
So this is the one that triggered my stop yesterday. See that pink bar? So it got me out. And then by the end of the day, although it still closed unchanged, I'm sorry, it still closed down. You can see the bar is that it closed, basically at day highs.
Yeah.
So I'm out when it broke 50 and I'm back in at like 51 and change or something like that, because it hit my stop and, I just moved on. And then all of a sudden, I think, there's some action in the oil market. And honestly, at that moment, Justin, I didn't know what had happened. I just knew that, the stock shook me out, and shakeouts are good unless you're in them, right? Isn't that what Bill would say? So I might not have been the only one that got shaken out of that stock. And my experience is, not everyone will go back to it. So, you've got some people trapped on the outside looking in. And today was a pretty good day for that. But it's in the right area. It's big. It's liquid. You've got accelerating earnings and sales for the last 3 quarters. And although it doesn't have any of the mutual fund ownership that we prefer, I would like to see like Fidelity Contra in there or something like that. There are a handful of Fidelity funds that do have a position. There is an Alger fund that has a position. And I think, my thesis is that they're trying to get out of the Apples and the Googles and the Facebooks of the world. And somebody is pushing these stocks, right? It went from 40 to 50 and consolidated this move so far. And I think there's more funds that can take a position for the next leg up.
So Scott, what got this on your radar? Like what with the price action? How did this come through your screens, and what made you kind of narrow it down and say, well, I really should focus on getting into a Schlumberger?
So if you pull up a weekly chart, you'll see on like the week of it's 10, is that 1014? And you've got that kind of where it's building that the right side of its base.
Yeah.
Right before the handle. So its relative strength line is making a new high right as the stock is about to break out and is breaking out. And I didn't own it at that time because I owned another stock that I owned Tidewater, which was same group, right? Oil and gas field services. And I was like, wow, do I want to own two stocks in the oil and gas field services? And thought, no, I'll just pass on SLB. I'll just stay with Tidewater. And but now it goes right on my screen, of the stocks I like to watch because it's in the right group, it's in the right sector. If that's what you want to focus on, the larger energy sector. And I'm a big proponent of relative strength. I think if you're going to buy individual stocks, you buy stocks that are stronger than the market. Otherwise, just buy the market for the diversification. I want to buy stocks that if the market goes up 10%, they should go up 15, 20, 25%. In that, let's say the market goes up 10% in like a 3-month leg up. I'm looking for stocks that are going to go up, 1.5 to 3.5 times what the market did.
Now, I guess one of the things that kind of seemed a little odd to me about the energy plays is they had these nice bases. I mean, if you just look at SLB here, kind of, orderly base, making some progress, another orderly base, making some progress, and then all of a sudden you had this deep base that kind of knocks out a lot of the previous support. And SLB wasn't alone. It seemed like there were a lot of 40% depth bases that happen in this area. That extra volatility, is that something that comes into your equation as, oh, is this going to be maybe too volatile to handle?
So commodity stocks they're difficult for sure. Gold stocks, uranium stocks, fertilizer stocks, oil stocks, they're difficult. But Justin, they're all difficult. Cloud service stocks, software stocks are hard. Consumer-oriented
stocks are hard.
They're hard. So, and you've got that added component of the price of oil, right? And oil is corrected. I think it topped around 125. And it went down to say, I don't know, the low is high 70s. I think maybe it's 80 now. But, it's like a 36% correction if I did my math right.
Yeah, I mean, you can look at USO, just, something
the problem with USO, right, isn't that like it's looking at the forward contract, but it's good enough, right? It's good enough.
So it gives you an idea, right?
Yeah, it corrected 32%. So just a little bit less. But yeah, so the underlying commodity corrected 32%. Imagine what would Apple do if the S&P corrected 32%? It'd probably go down 25 to 40%, something like that. So I think that's kind of what happened with these stocks. Some of them didn't come back. And so it's actually very good because now it's helping you, because for a while there were almost too many energy stocks, too many oil stocks to buy. And it's like, I don't know why Devon, why Tidewater, why Antero Resources. It's just like my head was spinning on which ones to own. I found myself kind of jumping around. Like if they were strong, I'd go buy it. If they were weak, I'd say, oh, maybe it's not a good one. I'd sell it. And it was only weak for a day or two, and then it'd come back. So I messed up a good portion of the gains from doing that. So I'm kind of glad this happened. I'm looking for the ones that made new highs quickly. And I don't know if you want to pull up Tidewater. You can see it still looks fine. It still looks good. I actually sold it on the way up because that's normally what I do. But it's not as close to new highs as SLB, which is why I've kind of made the switch. Now Tidewater is a much smaller company than SLB, so in the end, I sometimes think if Tidewater works, SLB is going to work, and if it doesn't work, if I get stopped in SLB, it's not like Tidewater is just going to hold up. The odds are super high. The correlation on these is probably 92 or something. So I think I like the bigger, more liquid SLB, and that's a name that I could see fast forward 6 months from now, 9 months from now, if this theme is going to play out. Then the Contras of the world, I could see them having positions in something like SLB.
Right. So let's go ahead and talk about another energy stock, APA. Corp. The ticker symbol here is APA. So from the field services to international explorers and producers, and it seems like the E&Ps, the explorers and producers, has been one of the areas of the super strength. So what is it about this one that attracted you? Another very deep base, 42% depth,
Yeah.
most recently. But what was it that made you think, hey, this is maybe worth a shot?
So I just bought this one yesterday, and so I've only been in it for one full trading day. I did not see that cup with handle, the 4370 pivot, unfortunately. It looks, and I usually like to turn the pattern rec off, and I like to look at the pattern myself. To me, like if I go back in time to when I used to get the books, and this showed up, this is a cup with handle with a 50 spot 58 pivot, right? I think that's that's a fairly easy to say. So I like this setup. It looks really good. Very big and liquid. Another right in the realm of the SLB, and in different but similar, right there as far as the sector. So I think this is the reason I want to bring this one up is I think if you don't have any exposure, you're looking to add more exposure, this one's more timely and more traditional as far as the buy points. SLB was kind of a non-traditional buy point, right? That was the old story that Bill told in his book. I walked into the brokerage firm and saw control data was up 3 on a bad tape. I love that story because I do that a lot on bad tape days, and the tape is just the market's acting poor. I just love to look for, okay, show me the stocks that are not down or even up. I love those days. They really help to shake the tree, and so that's kind of how I bought SLB in that way. But Apache looks more timely, and I think there's a pivot all the way to 50 spot 58.
Now on, and I was just going to mention, because it reminded me of how something you've shared on IBD Live is that you will sometimes put in a range where it's at in its trading range. So again, a lot of these that you're looking at, they were at the top of their trading ranges for the day, even though they were down, but kind of looking at those, hey, what's looking strong, what's holding up, what's kind of making progress throughout the trading day, as opposed to sinking as much as the indexes were.
Yeah, it's a feature and a bug that I have, Justin, because for the long, the job at IBD was the first real job that I ever had. I was a stockbroker, but I was more interested in trading my own account. I just wanted to trade, and I loved trading and still do. So I think I've tried to get away from that trading, maniacally style in the last, 10, 12 years as I've been with the company. Because one, you don't have the time to focus, but that's something I used to look for all the time, Justin, is do you see how it closed right on the highs? And if the market hadn't closed, I think the stock would still be going higher. And my experience is, especially in bull markets, now I don't know if we're in a bull market, maybe we're in an energy bull market, but my experience was always the very next day, at least on the open, it might not hold those gains, but at least on the open, it would open higher. And you'd have like a free look if you wanted to stay with it, or you could get heavy, was what I would do in my younger, more aggressive days. And then I would peel some off on the strong open, and leave a little bit, like SLB. SLB is a perfect example of what I would, even though it was down yesterday, it closed basically at or near the highs. I would hit that hard and then peel some off. It opened up like $1 or something, and then I would just peel some off and let the rest ride. So I do look for that. That kind of strength. I really like to see them really close in the upper, when I say upper range, I mean really upper range, 90 percentile or more. Yep.
Now, you've talked a lot about price. What about volume? And especially, look, we're in a holiday week here. We've got the Christmas holidays that'll be coming up soon. Volume has been really contracting, and so it's been tough to find some of these stocks showing strong price action with volume behind it. Is that a concern for you, or is it just, I'm going to look at the price and, excuse the volume away because of the holiday season?
It'd probably be a whole nother podcast if we got
Okay.
into volume. I don't know what it is about volume, Justin, but I feel like I've kind of gravitated away from it in the last handful of years. Slowly but surely, it's lost its relevance with my decision making. I've just put more and more weight in the price. I think the why, I don't know the why, to be honest, but I think it's that there's so many computers and robots and algorithms that trade against each other all day long, trying to make a penny or 2 pennies, that I just don't feel like the volume has been the best tell that it used to be. But I'm open to be proven wrong, and I do look at it. But like the fact that Apache didn't, the volume print today wasn't big, whether it's the 2 days before Thanksgiving or it's March 14th, it wouldn't matter to me. The way the price bar would give me more. But on weekly charts, I feel like the weekly volume is takes out some of that noise. So when I'm doing my work, I do kind of look a little bit more at the weekly volume and how the stock closed for the whole week, because now you've kind of filtered out, hopefully, a lot of that noise, the computers trading for pennies against each other. But on the daily chart, I don't know. This is you mentioned it, and so I looked. That's the first. That's the first I've even noticed that it wasn't much of a volume footprint today.
Okay. Well, let's go ahead and shift over away from energy and over to tech and talk about ACLS.
Yeah. So I think you want to buy stocks of companies that make stuff, stuff that you can drop on your foot, so to speak. And I guess a semiconductor is something you could drop on your foot. It might not hurt, but you could drop it on your foot. And
you might have difficulty finding it afterwards. It's so
true.
small nowadays, right?
or this might be really big equipment that you may break your foot. But
there you go. Like
that's
ASML.
true. Yeah, it's equipment.
Yeah. So this one is just showing amazing relative strength. You can see, like on a weekly, if you have the pattern rick on, that blue dot. And it's had this blue dot for, I think this is 2.5 weeks or so. Now, it is building this very, it's pretty deep cup, right? 40% with 11% handle. And you can see the previous cup didn't work. It broke out and failed pretty quickly. The cup before that didn't work as well. It broke out and failed pretty quickly. So I think this one might be 3rd time's the charm. And it could work because a lot of people, and even myself, I just was like, gosh, am I going to buy this breakout? The last 2 didn't work. Now, I almost always manufacture some type of buy point. And if you look at the daily, I'm sorry to jump around, but to me on the daily, that looks like a double bottom. And so I felt like the pivot was 68.83. And you could use like a Jesse Livermore shakeout rule. And so I bought this as it jumped above 60 on 11.4. To me, that was, that's the buy point. And if you're buying the way we like to buy, like if I want a 10% position in this stock, I'll buy 5% that day. To me, the risk reward is so skewed in my favor. If I'm wrong, I'll lose 5%. If I'm right, I'm going to buy more, buy another 3%. I'm going to buy another 2%. And now I've got a 10% position with some cushion. If it breaks out, I might take that. It depends on the market, because this stock's going to be more related to NASDAQ technology. And, I just spent the whole previous podcast telling you why I don't like NASDAQ technology, right?
Hypocrite.
This is almost like a counterbalance against my portfolio, because my portfolio is so heavily weighted in energy that I need a counterbalance. I need something to tell me whether I'm right on my thesis on energy, or maybe I'm wrong. And this is a whole new group, and I'm open to that. I want to be flexible to that. So I like having something like this that's different. And if it starts to work, like ASML was a stock that I owned and I sold it right before the CPI numbers, because I was worried about the CPI numbers. And which is something I never do. I never do things like that. But there were so many eyeballs on that CPI number. I just thought, it's just so much volatility around that.
So for ASML, you really, it was kind of the Livermore +3, right? You like the shakeout coming back up.
And it was the same thesis. I have a ton of energy. I'm short Tesla. I'm short some other names, which I'm not short anymore, but I was at that moment. And it's like, what could it hurt me to buy? This stock is one of the best companies, if not the best company in their niche.
Right.
What could it hurt me to own something like this if I get it wrong? Well, if I get it wrong, my shorts probably go down, and maybe my energy stocks go up. And if I get it right, it could offset if the shorts went down. And it turned out it was like a perfect best of both worlds. ASML went up, the shorts went down, and so. But I mishandled it, to be honest. But this is on my radar as well, because this is one of the better. Now the chart, I don't like the chart as much. It's got some overhead supply, but as far as companies out there, this is one of the best.
Well, that was one thing I was going to mention about ACLS. I mean, when you're talking about, I'm getting into, kind of something that's a little bit more on the tech side and, kind of hedging your bet. I mean, this has a very strong relative strength. This doesn't look like, if you look at SMH, for instance, which is the VanEck Semiconductor ETF, that's still, trading below its 40-week moving average line, whereas ACLS, it just looks very different from that ETF. It's not dragged down as much as a lot of the NASDAQ index has been, or chips in general.
Yeah, it's a very good observation, Justin. I wouldn't buy like Intel. So let's say I want exposure to the group. I didn't run to Intel or something like that. I wanted to find, in this group, what stocks are exhibiting unusual relative strength. That's my favorite one. And ACLS stood out like a sore thumb. There are some others. On Semi's acting really well. I think last I saw, 93 EPS. And Amcor, AMKR is a 90. I said EPS, I'm sorry, relative strength. Amcor is a 96. ASML, when I bought it, honestly, the RS now is 73, but when I bought it, I have to admit it was pretty low. I think it was in the 40s. But that was more on, a play on the company, the quality of the company versus, the stock action.
Yeah. Well, Scott, I think you gave people a lot to think about, learning from your style. And again, 25 years of experience, that's nothing to sneeze at. So thank you so much for being on the show.
Of course. It's always fun. And I still have the record? This is like my 5th one.
Oh, yeah. Are you going to be like the Tom Hanks, Chevy Chase of or Alec Baldwin now, I guess, on SNL.
Of SNL, is Alec Baldwin that have the record?
I can't. He's got to be up there, I would imagine.
Do you guys not have my home address? Because I don't remember getting the watch.
Right. Well, you know what? No, go ahead. Why don't you give your home address right now? So,
It's okay. I have a watch. My phone will tell me what time it is. Thanks, though. I appreciate the offer.
Anytime. Thanks for coming on.
All right, guys.
And
see you later. Thank you.
Week. Okay. And on the show next week, we had a postponement with Jared Blickery, but we will have him on the show. He is, he's been on Yahoo Finance for a good long time, and he's had Arusha and I both on his show. So we felt it was time to have him on ours. So hope you join us for that next week. Hope everyone has a good Thanksgiving holiday, and we'll see you next time. Thanks for watching. Make sure to subscribe, rate, and review our podcast if you haven't already. We'd really appreciate it. You can also send us your questions and comments to investingpodcast@investors.com. We would love to hear from you and may use your comments on an upcoming episode.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.